finance. It seems hard to learn. But is it really? Wall Street likes to overcomplicate everything money related, confusing a lot of people. Join us on this podcast as we help break down the world of money for you to understand from a relatable perspective. This is Finance Simplified. Hey everyone, how's it going? My name is Rohan, and I want to welcome you to today's episode of Finance Simplified, the official podcast for Street Fins. We're here to simplify finance for you, so you can actually understand it to better your future. And today, we will be simplifying the topic of valuation with a very special guest, Dr. Aswath Damodaran. Aswath is a professor of corporate finance and equity valuation at the Stern School of Business at NYU. I couldn't be more excited for our upcoming discussion. Aswath, often referred to as Wall Street's Dean of Valuation, has been widely recognized as a go-to expert on valuation for many years. He has taught for over 3 decades and has received many fellowships and awards during his career. He often goes on CNBC and other business news channels to share his views on finance and investing. He has written several books on valuation and finance, which I'll link in the episode's description. Aswath received his MBA and Ph.D. both from UCLA. When it comes to the top academics in finance, you really can't get much better than Aswath. Aswath, welcome to the podcast.
Thank you.
Could you kind of give us an intro to how you got started with finance?
Well, I think it's as much by accident as a reflection of what I think my strengths were. My strengths have always been that I see the big picture and I can work well with numbers. And finance seemed to be a natural place to go. I thought about accounting, but it was too rigid. There's not enough room for being creative. Finance allowed me to be creative and work with numbers at the same time. Not too many disciplines do that.
Awesome. So let's get started with our discussion on valuation. Valuation sort of makes Wall Street tick, right?
Valuation does not make Wall Street tick. I think one of the big mistakes people make is they mistake valuation for pricing. Valuation is basically attaching a number to an asset based on its characteristics, its cash flows, its growth, its risk. It's about valuing a company or an asset as a business. Wall Street is all about demand and supply and attaching a price. So don't mistake what happens on Wall Street for valuation. It's really pricing.
Thanks for clarifying that. Could you kind of tell us about the history of valuation and how the practice and study has kind of evolved throughout time?
It's as long as people have been buying and selling businesses, valuation has been around, right? I mean, you've got to attach a number to a business, whether you are a cave person selling your new tools business to another cave person all the way through today's IPO of Uber. It's always been about, when you have to sell a business, valuation is always involved. I mean, what's different about the last 100 years is twofold. The first is we have more access to the data and we're more powerful tools. So it's really not that the process of valuation has become more sophisticated, but the things we can do to arrive at a value have become more powerful, more accessible. So that's really the difference, is really not in the fundamental principles, but in how we can use data and use tools to arrive at that.
Gotcha. So most people, really like first-time investors, many of whom will be listening to this podcast, hopefully, they think of finance as, a bunch of complex spreadsheets, numbers, models, all that type of stuff. But you also say that with valuation, there's a narrative side to it. Could you kind of go into that side of it?
Yeah, every spreadsheet tells a story, right? And you can put all the numbers you want, but behind the numbers, there's a story. And the only question is, do you know the story you're telling? So lots of analysts put out numbers. They don't even have a sense of what story they're telling. In fact, if you take their own spreadsheet and kind of read back to them the story that you're seeing in the spreadsheet, they're surprised. They say, really? That's what I'm saying? And I think we need more awareness. Spreadsheets are just numbers, and they don't become valuations until those numbers are tied together by a story. So when you tell me the revenues for a company are $5 billion, and I ask you where the $5 billion came from, the answer I don't want here is it's because you used 25% growth for the first 5 years and 10% thereafter. It has to come from a story about the company, the market it's in, its competition that will allow them to generate $10 billion in revenues. So every number in evaluation has a story embedded in it, and you better be aware of that story if you're doing that valuation or investing based on it.
What's a story for a company these days that you've looked at, and could you kind of walk us through that story?
Well, let's take Beyond Meat, right? A story of the best performing IPO of this year it's a meatless meat company, and it's going after a market. The market it's going after are people who love to eat meat but feel guilty every time they eat meat, either because of their health reasons or because they think they're damaging the environment, because the carbon footprint of eating meat is so much greater than the carbon footprint of being a vegetarian that Beyond Meat is going after the target market. So they've created a product that tastes like meat, looks like meat, has the texture of meat, but it's made of pea protein. So it's a company that went public at $40 per share, rough value of about $3 billion. And when you sit down to value Beyond Meat, the question you have to ask is, hey, how big will this market get? And when you think about it, it's an interesting question, because you're not approaching the vegetarian market, because there are lots of natural vegetarians in Asia who've never been anything but vegetarians. They're not remotely interested in eating something that tastes or looks like meat. So it's going after a market of people who used to like meat, who still love meat, but don't want to eat meat anymore. Now, that's the basis for your story. The question you have to then ask is, how big will that market become? What are the products that will compete for the market? And you're looking at a very young market where new products are going to come out and new health findings are probably going to come out. It's an evolving story. So the story you're telling for the moment is of a growing market, a vegan market that is going to be catered to by these meatless meat products, with Beyond Meat being one of the leaders. And then you've got to tell a story about why Beyond Meat will beat out Impossible Foods or any of the other competitors, why it's going to be better. So there are layers to the story. One is about the overall market. The second is about how Beyond Meat will work against competition. And the third is how this market will evolve over time in terms of, will it be a brand name kind of market where people buy a product because they recognize the brand name, or is it going to be a commodity market where people are going to go after the lowest prices? So you're taking a leap of faith here when you tell a story, and you're going to be wrong pretty much in every dimension. That's what investors have to be willing to do. But what they have to do is also be willing to revisit their story when they discover data that tells them they're being wrong.
Yeah, the story is, well, I live in Silicon Valley, and here stories are a very large factor of most of all the valuation that goes on with the venture capitalists and everything.
What the young company, it's all story, right? Because there are no history that you can point to. The question you've got to ask when you hear that story is it a plausible story? Is it a probable story? Because I have this 3P test. Is it possible? Is it plausible? Is it probable? So when you take a story or listen to a story that a founder of a startup is telling you, think of it as the equivalent of watching Shark Tank, right? A business founder comes out and describes a business. You have to ask the questions that will tell you whether this idea is possible. It might not be. It could be a fairy tale. Whether it's plausible, whether somebody has done something like this before, and whether it's probable, in which case you have shown me proof that you can actually pull it off, at least in one location or in one city. So one of the tests of an investor is, especially when you're investing in young companies, is whether you can ask the right questions to make that judgment.
Backtracking a little bit here, going back to just valuation basics.
Yeah.
There's two types of valuation. There's intrinsic and then there's relative. Could you kind of explain both of them?
There's only one kind of valuation. There's intrinsic. The other is really pricing. You say relative valuation, you're saying I'm going to price something based on how similar assets are being priced. So think about when you bought your house, right? The realtor named the price for your house, said it's worth $500,000. If you're in Silicon Valley, $2 million, didn't do a discounted cash flow valuation or an intrinsic valuation of the house. They looked at other houses in the neighborhood, what they'd sold for, and attached a price to your house. So relative valuation is pricing. Intrinsic valuation is about trying to attach a number to a company based on its fundamentals. So it's true, even in my books, I call it relative valuation, but relative valuation is really pricing. Intrinsic valuation is about attaching a value to business based on its fundamentals.
So let's talk about intrinsic valuation. Could you kind of elaborate on some of the more common methods used for intrinsic valuation?
Well, any intrinsic valuation method has to bring in your cash flows, has to figure out when those cash flows happen and adjust for the risk in those cash flows. So when you see a discounted cash flow model, it's not actually a technique. It's really a way of saying, hey, this is about cash flows, timing, and risk. I've got to show those cash flows. I've got to show where they happen over time. So discounted cash flow valuation is perhaps the most widely used approach to intrinsic valuation, but it's not new. It's been around forever. What's new is now we have present value tables. We have Excel doing present values for us. But if you think that the glassmaker in Venice in the 1400s who sold this business did not think about cash flows when they would come in. and the risk in those cash flows, you're mistaken. So it's always been with us. We just made it more explicit in the last few decades in the form of a model.
So to summarize what he's said so far, discounted cash flow, which is the most widely used technique for valuation, takes into account three things: when you receive a cash flow, what the amount of that cash flow is, and the risk you're taking to receive those cash flows. Once again, a cash flow is simply the amount of cash flowing into a company for a given period of time. For example, with teenagers, cash in is perhaps parents giving you an allowance, and cash out may be paying to go to a concert. From an accounting perspective, cash flow gets more complicated, but it's still based on the concept that it's the cash in and cash out of an entity, whether that's a person or a company. Discounted cash flow works like this. You predict that a company is expected to bring in cash flows for a certain period of time, let's say 5 years. But those cash flows aren't guaranteed because the future is uncertain. The company may go bankrupt or slow down in growth, which can affect the cash flows it receives. Because of that uncertainty, there is risk, and from that risk arises something called the discount rate. Conceptually, the discount rate is a rate of return that represents the risk of an investment. What is that risk? It's the risk of not getting the cash flows you predicted you would get in the future. There are many ways to come up with the discount rate, and I'll link an article in the description that talks about those different ways. But with this discount rate, you find the present values of the predicted future cash flows. What does that mean? Well, according to the time value of money, $1 today is worth more than $1 tomorrow. Therefore, $100 that I receive in a year from now is not worth $100 to me today. It'll be worth less. The way you find out how much less is by discounting the $100 with the discount rate. Basically, if I think that company A is going to receive $100,000 in a year from now in cash flow, and I think that the discount rate is around 10%, then the present value of that $100,000 in a year from now is $100,000 divided by 1 plus 10% to the power of the year, which is 1. That gets me approximately $91,000. That means that based on the risk of the investment, the $100,000 that I was expecting 1 year from now is actually worth $91,000 to me today. But what if that $100,000 was expected in 2 years rather than in 1? The same thing applies, except instead of doing 100,000 divided by 1 plus 10% to the first, we raise the denominator to the second because it's 2 years from now. We would get around $82,600 for the present value of receiving $100,000 2 years from now. After estimating the present values for all your future cash flows, sum them up, and that's your intrinsic valuation for the company. Back to the conversation. So with relative value, going back to relative value, and how you called it pricing, my question is how does that manifest itself? Through what metrics and factors does relative value come into play?
Anytime you see a pricing multiple, and often let's start. If you're going to comparing houses, you can compare the price per house. But if you're comparing stocks, you can't compare the price per share for a simple reason. The per share price is almost arbitrary. So when I, as a company, decide to issue 1,000 shares, the price per share is going to be much higher than if I issue 100,000 shares on the same company, because I'm dividing the value into more units. So since you cannot compare price per share across companies, you have to standardize price, which sounds fancy, but you have to divide the price by something. Price by earnings, price by book value. So when you see a multiple, and often with equity research reports, you see a multiple, price earnings ratio, EV to EBITDA, you're using a standardized price. And what you're doing is you're comparing the standardized price across companies that you called similar. Now, what's similar is actually subjective. So if I ask you to value Microsoft, you've got to find 15 companies similar to Microsoft. Well, good luck with that. So what do people do? They bend the definition of similar. So they say, these are 15 other big software companies. Microsoft is a big software company. So I'm going to price Microsoft based on these 15 other software companies. So already you can see that the way you standardize price is a subjective judgment, because you can scale price to earnings, you can scale price to book value, you can scale price to even revenues. And what you call comparable is also subjective, which also effectively means that you and I can price the same stock and end up with different pricing judgments. But the nature of pricing is you got to find other companies like yours that are traded out there, see what they're traded at, and try to attach a price to your company based on how those other companies are being priced.
So with the multiples, right, I watched one of your videos. It was your online valuation course, and it was in it. You said that you have like a 4-step process for learning how to understand and deal with multiples. Could you walk us through that?
Well, I mean, your choice of multiple, you've got to make sure you're not working with a multiple that's ill-defined, that's not consistently defined. And the reason is very simple. When you value a company, you can value either the entire company or you can value just the equity in the company. You see, what's the difference? Think about buying a house, right? The house price is the house price. But if I ask you how much equity do you have in the house, it's going to be whatever the house price is minus what you owe the bank as a mortgage. Same thing applies to the company. When I ask you what's a company worth, you can give me a number. But then I ask you what's your equity in the company worth, it's going to be a much smaller number, especially if you have a lot of debt. So the numerator in a multiple can either be equity value, which is the market cap of the company, or it can be entire value, which is often called enterprise value. Simple rule in multiples is the numerator is an equity value. The denominator has to be an equity value as well. So if you're defining earnings, for instance, you can look at net income, which is earnings left over for equity investors. With enterprise value, you've got to define earnings differently. It's got to be earnings to all investors, even lenders. So that's why you look at operating income or EBITDA. So you have to make sure you're working with a multiple that consistently defines. Second, since this is a data problem, it's not a finance problem, you can't throw away data. You can't just say the average PE for the other stocks is 15. If you have 50 companies in your sample, you've got to play some money ball. You've got to look at what's high, what's low. I think people are incredibly lazy when it comes to data. They act like it's 1965 when getting the data was difficult. Today, if you're going to look at 50 companies, don't throw away data. Look at what causes pricing to be different across the companies. Then you've got to see what drives the multiple you play. What are the variables that drive that multiple? Every multiple is embedded in it assumptions about cash flows, growth, and risk. Those assumptions you're running away from are chasing you down. You've got to find out those variables. And the last step, you've got to control for those differences. Define, describe, analyze, apply. It's a 4-step process. And it's going to be tough when you first try it because it'll be a first time. But the more you do it, the more comfortable you become with the process.
Gotcha. So with some of these metrics that investors look at, what would you say are the most important multiples and metrics that relative valuation looks at?
It doesn't have to be important. It just has to be consistent, right? I mean, basically, there is no right multiple or no wrong multiple. It's just once you picked a multiple, you got to take it the distance. So the problem that people have is often they pick a multiple, but they're not entirely consistent about the process. So rather than spend too much time asking what's the right multiple, ask yourself the question of having picked a multiple, what are the follow-up steps I need to make sure that I'm not picking stocks that look cheap but are really not cheap.
So it's always about consistency with the multiple.
Exactly.
So one thing I've sort of learned throughout the past year is that valuations, they're never exact. They're always just estimates. Could you kind of talk about that idea that the inherent nature of a valuation is that it's an estimate?
In fact, again, if you think about it, don't over-intellectualize this, right? Why is it an estimate? Why is valuation an estimate? For now, value beyond meat, why is it an estimate?
Well, there's just a lot of uncertainty and lack of information all the time.
Where's the uncertainty coming from?
Future.
I mean, here's a very simple exercise. Get up every morning, look into the mirror and say, I am not God. Hey, none of us is. So when you are valuing a company, you are playing God, right? You're making judgments about the future. And guess what? Those judgments are going to be wrong, not because you haven't collected enough information. People often make that mistake. If I collect more information, I'm going to get more certain. Hey, that's not going to happen. In the case of Beyond Meat, you can collect every piece of information on this market out there, and you're going to still be uncertain. Why? Because we don't know what the future will bring. We don't know how fast global warming is going to be. We don't know what laws governments might pass on how much meat you can eat. Those are all in the future. So when people say, is valuation uncertain? Again, they say, wait, no, what do you think? Of course it's uncertain. We're making judgments about a future that's uncertain. And that uncertainty is going to be there no matter how much information you collect and how big your model gets. Uncertainty, I mean, it's the nature of the process. So I think what you have to do is learn to live with the uncertainty rather than fight it. What gets people into trouble is being in denial. They don't want to deal with uncertainty. They want to push it under a rock and act like it's not there. I tell people, face up to it. Accept the fact you're uncertain. Accept the fact that you're going to be wrong 100% of the time. Accept the fact that you've got to constantly revisit your story and valuation
So one thing that's tied to the idea of uncertainty is volatility and the measure of beta. Could you kind of explain what beta is and why it's so used?
Well, uncertainty manifests itself as your stock price is changing, right? I mean, if you have uncertainty, your earnings are going to change. And beta is not that big a deal in valuation. It's just a small part of a very big picture. Again, people, I think, when they take finance classes or they first see finance, think that this must be a big deal. We need some kind of discount rate to do discounted cash flow valuation. Let's go back to the intuition. If I offer you a riskier, more uncertain cash flow in the future, then you're going to demand a much smaller value today for that. I mean, you're not going to be willing to pay as high a price for that uncertain cash flow. So the discount rate becomes your mechanism for conveying the risk you see in your cash flow. Beta happens to be one tool of capturing that uncertainty and bringing it into your discount rate. If you don't like betas, I tell people just throw it out of the window. Think of a different way of dealing with uncertainty, bring it into your discount rate. We're on the road again. So I think people make a big deal about risk and return models and uncertain and beta. As somebody does valuation, I'll tell you, uncertainty is way down. Measuring beta is way down on my list of important things to do. When I valued Beyond Meat, I spent about 3 hours on the valuation. I probably spent a minute of that on the discount rate. That's not what's going to make or break my valuation. It's a very small piece of a very big puzzle.
Yeah, so there's the whole idea that there's multiple ways to find that discount rate, and then one of them is through CAPM, which incorporates beta, and then another is through the weighted average cost of capital.
Those are not alternatives. The CAPM it gives you a beta, which gives you a cost of equity. The cost of equity goes into the cost of capital. So those are not either or. You need the beta to get the cost of equity. You need the cost of equity to get the cost of capital. The debate is about how you get that cost of equity. You can use beta in the CAPM. You can use multiple betas in an arbitrage pricing model. You might even use subjective factors, accounting ratios to come up with the cost of equity. So the real debate is about how you get the cost of equity, because the cost of equity is the rate of return you're demanding as an investor for buying stock in a company. And that's going to be tough to estimate because I've got to be a mind reader to estimate. So the big debate is about what kind of risk and return model to use to come up with the cost of equity in the first place.
So with the cost of equity, there's also the cost of debt. Could you kind of explain that too?
It's the rate at which you can borrow money long term today. So think of starting a business. You go to the bank to borrow money long term. What will it cost you as an interest rate? You know what's going to drive it? First is your history as a company. If you're doing a startup and you have no history, the bank's probably going to charge you a really high interest rate. Why? Because they don't know you. They're worried that you might not pay them back. The cost of debt is the rate at which you can borrow money long term today.
Right. Sort of switching gears and kind of talking about how valuation differs not just from intrinsic to relative, but also how it differs across different companies and different industries. For example, how would the valuation of like Netflix versus Home Depot differ, or like Amazon versus a bank?
Well, I think fundamentally, the younger a company is, the more it's changing, the more uncertain they'll be in the future. Right, so it's not so much the names of the companies you threw, but the companies that you suggest listed first. Amazon and Netflix are still young and evolving. The companies Home Depot and JP Morgan Chase as a bank are more established companies with a long history. So you're going to feel more comfortable valuing the latter over the former because you'll have more data, the business model is established, there's less uncertainty about the future. But guess what? The payoff to doing valuation is greater with a Netflix or an Amazon than it is with Home Depot or a bank, simply because everybody else has exactly the same kind of advantage you do. So I tell people to go where it's darkest. Don't go to the companies you can value easiest because everybody else. What the factors that make them easy to value are factors that are accessible or available to everybody valuing that company. So young companies are more difficult to value. It's just the nature of the process. It's not because there's something exotic about them, but because the future is still out there. And you have to make more judgments about the future. So the real challenge is getting over that discomfort you feel about making judgments in the future. Remember I said you're playing God, and that makes people uncomfortable. In the sense with young companies, you play God more.
Gotcha. So on our last episode, we had Howard Marks actually come and he was our guest. Mm-hmm. And before that, we had a venture capitalist as well. So that's two separate sides of the investing spectrum. And they both talked about valuation. So from your perspective, how does valuation differ from a value investor like Howard Marks and a growth investor like a venture capitalist?
Value is value. Right? So it's really no different. The only difference is the kind of investment philosophy you bring to the table. A growth investor is making his bet that his assessment of the value of growth is better than most other people making that assessment. An old-time value investor thinks that his assessment of the value of assets in place, investments that a company's already made, you're making better judgments. I actually have a problem with old-time value investors. They think they're special. They think that they're somehow righteous, that they're the good investors. There's no time for being righteous in this process. There's nothing inherently noble about being an old-time value investor and dicey about being a growth investor. You're just playing to different strengths. So I think that, I think both of them are trying to do the same thing, which is at the end of the game, they want to make money. They want to buy the stock at a low price and sell it at a much higher price. And the tools they get and the strengths they bring to the table might be different, but I don't view the end game as any different.
Going back to the discussion about equity and the cost of equity, could you kind of tell us what an equity risk premium is?
Yeah, the equity risk premium is the price of risk, because if you're investing in stocks, you're operating in a market where there are millions of investors like you all investing in stocks. The equity risk premium is the price of risk in the equity market. You see what drives it? One is your perception as collectively as investors of how risky the market is. That's why when you have a meltdown in a country or you have a trade war, equity risk premiums go up because people get more scared about the future. It also reflects how risk averse investors are, and that's determined by how prosperous the country is and how secure you feel in your job. So equity risk premiums change all the time. They go up, they go down, and part of your challenge in valuation is making sure that the price of risk you're using in your valuation reflects the price of risk that's close to reality. That's why I estimate equity risk premiums for the S&P 500 at the start of every month on my website. It's not for others, it's for me. When I value companies that month, that's the equity risk premium I would be using.
Right. So it's also like how much would the S&P 500 or stocks have to offer for someone to take that risk in investing in stocks from something safer like bonds. Going back to what I just said bonds, and that's a less risky investment. So could you also talk about the risk-free rate?
Well, the risk-free rate is what you can earn in a guaranteed investment. So let's suppose you decide to put your money in something that's guaranteed today. What rate would you make? And of course, that rate is going to vary depending on whether you're putting it in for 6 weeks or 6 years. That's why the risk-free rate is going to vary depending on whether you're looking at short-term or long-term. It's going to vary depending on what currency you're working in. What you can make risk-free in US dollars is going to be higher than what you can make risk-free in euros right now. And what you can make risk-free in Australian dollars might be higher than what you can make in US dollars. So it's going to vary across currencies. It's going to vary depending on the maturity you're looking at. And it's going to vary across time.
So I'm curious, actually, because you're talking about going through the story and evaluating a company. So if we take the story of Apple, like what steps would you take to value a company like that?
What would your story for Apple be right now?
They have one of the best products right now. It's the iPhone. It's always in demand.
But is it growing?
I'm not sure if it's growing right now. I haven't checked the latest reports.
The reality is everybody has a smartphone now.
Yeah.
So now for you to get an iPhone, you got to take an iPhone 9 and switch to an iPhone 10, or you got to get somebody who's got a Samsung Galaxy. It's a very different business than it was 10 years ago. The iPhone business 10 years ago was a growing business because you were getting people who still had flip phones switching to smartphones. So Apple is a mature company. It's a mature cash machine. That's my story. Nothing more, nothing less. It's a great company if you like cash flows coming in. If you're looking for growth, Apple's not it. There's no growth left in Apple. Or if there's growth, it's going to be low growth. That doesn't make it a bad company. It is a mature company that's throwing off cash like no other company in history has. And you got to take it for what it's worth and invest in it based on that premise.
Right. Okay. It is very mature versus something that's like a startup.
Or even relative to Adobe. I mean, it's a mature company, even relative to other big companies, simply because it's a smartphone company. Everything else it does is kind of a side story. It's a smartphone company, and it's the smartphone market is mature. When you're a big company in a mature market, guess what? The only way you get growth is by cutting prices and trying to get market share away from Samsung. But Apple will not do that because its profit margins on the iPhone are what keep it going. And if it cuts prices, then it becomes Samsung, much lower margins. So I think whether it's Samsung or Huawei or any of the competitors, Apple has a niche product that commands a huge margin, and it doesn't want to kill the goose that lays the golden eggs.
Gotcha. So we've talked a lot about kind of the micro of companies, talking about the multiples, their rates of growth, and the cost of capital and debt. What about the macro? What aspects of macro affect valuation?
Everything, right? You live in a macro environment. Interest rates matter, inflation matters. That said, is it your job to forecast the macro? If I ask you to value a company, I don't want to be a macro forecaster and tell me that interest rates are going to go up or down. That's going to mess up your valuation. So the macro affects your value, but you have no business forecasting macro when your job is to value a company. It's not my job to tell you the dollar will get stronger, interest rates will come down, inflation will go up. In fact, if you want macro advice, I should give you macro advice. If you want to ask me what Apple's worth, I should be valuing Apple as is. So the reality is macro variables affect value, but you shouldn't be forecasting any of them when you try to value a company.
It reminds me of something Howard Marks said last time when he was on the podcast. He said something to the effect of the macro is more important, but it's also unknowable and almost unforecastable, and it's really basically hard to forecast all the time. So it's better to focus on the micro.
In fact, I'll restate it even more strongly. It's hard to forecast any of the time, not even all of the time. Your odds are better than tossing a coin on which direction interest rates are going to go than hiring a macro forecaster to do it for you. Macro forecasting exists for one reason and one reason alone, to make astrologers look good. It's basically a horrifically bad discipline, but people pay because they think that it basically gives companies and investors a way of passing the buck, saying it wasn't my fault. I listened to JP Morgan Chase tell me that interest rates would go up or down. So macro forecasting is one of those. I call it the impossible dream. The Broadway song kind of plays in my head every time I see somebody do macro forecast. We all tried. I'm no exception. We all tried to be macro forecaster. It never seems to work.
Yeah, I definitely have experience trying and failing with my macro forecasts in the past when I was starting out.
If you fail all of the time, you're a very good macro forecaster, because then all I have to do is take your macro forecast and do the exact opposite.
Yeah.
If macro forecaster is always wrong, that's perfect. You found a perfect forecaster.
I made a lot of mistakes, like learning about finance early on. So as a professor at NYU, what are some of the misconceptions that you see your students at Stern coming into finance with and having?
Well, misconception, because finance is just a kind of general discipline. I mean, misconceptions about take what's an end game for a company. The misconception is that companies can somehow keep all these stakeholders happy, labor, society. In fact, the CEOs seem to have the same misconception. CEOs in the Business Roundtable, I thought it was the most absurd statement ever, where they said we'll be all things to all people. What the end result is going to be, they're going to be none of those things to any of the people. So starting with what's the end game for a company? Why do publicly traded companies get founded? Growth is good. That's what we've been told. That's not true. For 2/3 of companies around the world, growth is value destructive. And I blame, it's not even people entering my classes, people in other disciplines, corporate strategy, people who think that creating a sustainable corporation is somehow by itself a good thing. Why should a corporation be sustained? It's a legal entity. If the reason for your existence has gone away, you should go away with it. So the misconceptions are not just among students coming into my class. They're widely held among people in the discipline. And sometimes the only reason I bring the data out is to show people, hey, you might believe that growth is good, but how do you explain the fact that 2/3 of companies around the world destroy value as they grow? How do you explain the fact that most managers manage companies for the best interests of managers, not shareholders? So I think a lot of misconceptions you can deal with playing Moneyball. And that's what I call it. And I draw on Michael Lewis's term for what Billy Beane did with the Oakland A's. Let the data answer the question. You'd be surprised at how much people take as truth in valuation is actually false, doesn't hold up to scrutiny.
Gotcha. So it's not really just for the students, and it's about how really the perceptions kind of is off.
Like I said, 181 CEOs, some of the CEOs of the largest companies either don't know what they're talking about or they're being completely deceptive. I don't know which one to attach it because either possibility is scary. These are CEOs of companies. You think, that they would know what the end game for a corporation is, but they don't seem to.
So we're almost out of time, but I want to touch on something you said earlier. You mentioned that you had kids and you gave them allowances and everything like that. So when your kids were, teenagers or ready to get into the workforce, or maybe when they were younger too, what lessons about money and money management did you teach them?
You know what? Getting lessons from your parent is a terrible place to get them, because what's your reaction? You're going to do the exact opposite. So I try not to give advice unless I'm asked for it, because at some point in time, they will need to learn this on their own. I mean, I believe this is true for all investors. You got to internalize things. You can't read about how to manage your money. You can't just listen to other people. You got to think through what works for you. I mean, I think ultimately what works for me is not going to work for my kids. Each of them has to figure out what will work for them. And the only way to figure it out is to learn from their own mistakes. Okay? So I give them advice anytime they ask me for advice. But I'm not going to give unsolicited advice on this is what you should be doing, because I think that's a mistake. I think that that people need to kind of work through, because none of the stuff that I've told you requires a finance degree or that you go into finance. It's common sense. And sometimes people get greedy and then they get stupid. But common sense ultimately is at the basis for almost every financial principle. So I think they can figure it out on their own. They're bright kids. So, I'm going to trust them to figure things out on their own. So far, so good.
Yeah, I definitely have been figuring things out on my own over here through my mistakes in finance and everything like that. Aswath, thank you so much for being on the podcast today. It truly was a pleasure to speak to you.
Thank you.
Hey guys, I want to thank you so much for listening to this episode of the podcast. It truly means the world to us. Please give us your thoughts and feedback on today's episode, what you liked, disliked, and what we could do better. Once again, thanks to the awesome Dr. Aswath Damodaran for the insightful conversation. I hope you guys learned more about valuation in this episode. Once again, we are really happy that you're taking the initiative to learn finance and to better your future. If you'd like to get in touch with us, please email streetfins@gmail.com. And if you haven't already, we highly encourage you to check out streetfins.com for articles, videos, and other content, and to subscribe to our newsletter. Join the StreetFins community and follow us on social media, links in the description, and share us with your friends so that they can learn about finance too. We'll talk to you next time on Finance Simplified.